Hi, welcome everybody to our latest Friday Market Insights. My name is Thomas Holloway and I'm a portfolio manager, and I'm joined today by Wayne Wachell, CEO of Janus Capital. Thanks for being with us, Wayne.
Good to be here.
So we'll kick it off as always with what happened in the market this week, Wayne?
Well, the market this week was a bit of a reversal from the first quarter. The first quarter we had value stocks run, growth stocks didn't do that well. And also the first quarter bonds backed up. This week here, the growth stocks did better. The markets were up. We had the 4K on the S&P 500 today, which is quite a landmark, and driven more by the technology this week. Value stocks took a bit of a rest during the course of this week. So bonds simply have backed up so much during the first quarter. Yields backed up over 80 basis points. The US 10-year hit 177. Took a bit of a rest this week, and yields came down about 10 basis points. And that helped the long duration tech stocks and growth stocks through the course of the week.
Great, thanks for that. And really great intro, I guess. Since today is April 1st, I'm not going to make any jokes, but I am going to reflect.
No. Don't go there.
But I will reflect on the fact that, in financial markets, we mark things by quarters. So, yesterday was quarter end. Taking a step back, not just talking about the week, but on the whole quarter, what were the big outcomes for the quarter?
Well, the bifurcation between stocks and bonds. Stocks, the S&P 500 was up over 6%, TSX up around 9%. The main bond index in Canada was down almost 5%. So big difference in terms of what performed, for the quarter. As well, value did very well compared to growth. Growth stocks kind of just went sideways. Value was upsized. Small cap did well. And our dividend strategy did very well during the quarter as well, because more value driven, less tech stocks in there. So quite a quarter. And we think that's a theme that'll probably continue through the course of this year as we get more evidence of the pandemic subsiding. But it was a big quarter and a good quarter for value and for our dividend strategy.
Great. Yeah, it is quite a surprising number in the bond market. I guess something that we've been talking about maybe happening for a long time. You mentioned the bond, the main universe benchmark. I believe most clients would be positioned a bit shorter in duration than that.
Well, yes, at Janus, our term to maturity or duration was much shorter than the benchmark. And we had more exposure to corporate sector, the spread sector, that is less sensitive when rates back up. And the government of Canada and treasuries tend to get hit harder during this kind of environment. So yeah, that would have helped our performance in Q1 and also our exposure to value. And also we had more stock. We were overweight stocks and underweight bonds as well during the quarter. So
yeah, thanks for that. Of course, we can have more detailed attribution once we get a couple of days to think about it. So yeah, I think I just wanted to carry on with that theme. I mean, one reason why the bond market returns were so weak this quarter is, of course, that the yields went up, and they went up in particular the tens or the longs part of the curve, and the front end has been much more anchored where the central banks can keep it that way. So that's what we call the yield curve. So the yield curve is obviously important to the bond market, but it's also quite important to some of our equity holdings. And in particular, I wanted to talk about the banking sector. So this much steeper yield curve is, I think, a positive for banks. But can you kind of talk us through how that works?
Yes, well, yield curve, the banks tend to trade with the yield curve. If the yield curve goes up in terms of rates go up to the long end, it does well because it can borrow at lower rates and invest at higher rates. And also the economy yield curve also is a forecast of stronger economic growth. Stronger economic growth means better collateral values, better asset values within their portfolio. So it really helps the banks. It's a big play. The banks have underperformed for a long time. We went longer the banks versus the benchmark in Q4 of last year. We're hanging on that position because we think there's more to run here. If we see inflation coming back this year, we don't see inflation coming back big, but in the next couple of years, it's going to be a little stronger, I think, than it's been over the past decade. That also helps bank collateral values. And as rates go up, banks have more cash flow. That also helps their valuation compared to technology stocks. So we think there's a good play there. And it's going to be, I think, it's going to have some legs, I think, in the course of this year as well. So we're positioned there, and hopefully we'll see that come to bear.
Yeah, it also connects back to your earlier comments about value. Banks are one of the more classic value sectors, so those comments they make sense with each other. Sticking with the banking sector, Jen is also, in addition to making these kind of sector or asset class calls, obviously also picks down to the individual securities. So, one bank versus another. Can you talk a little bit about how the investment team sifts through dozens of banks to decide which ones to buy?
Well, we have a multi-style approach at Genis. We look at value, we look at growth, we look at technical factors like momentum, we look at analyst revision. We even have some ESG factors we include. And that all goes into creating a model that we actually back test and has predictive value. And so we have models specifically for the banks themselves, for the financial sector, which tend to be a little more value oriented. Then we also have other models that look across the overall market. So we get different perspectives, one for sector, one for the overall market. And within that, from that perspective, that's how we look at banks. And within our portfolios, for example, in Canada, our models have favored the TD Bank and Royal Bank for the past couple of years. And they're just more diversified. They have more growth. They're actually in the US marketplace. They actually are big time into wealth management as well. So those things give them more growth and more analyst revision besides value. So they tend to be favored within our approach.
Excellent, thank you. A common question that we get from some of our fossil-free clients is, what about the Canadian banks? Don't they lend to oil and gas producers or do IPOs for them and stuff like that? Should we be more cautious about the Canadian banks given a fossil-free lens?
When you look at companies through the lens of ESG, it's really a data or metric game. You need data. You have to know what's going on within the companies. And right now at Genis, we have over 1,800 different metrics we can look at companies from their ESG exposure. Within the banks, we don't have the same kind of data or telemetry. And we're involved in lobbying them to get better transparency in their loan portfolios. That's going to take time. And what we've done to deal with that lack of data or telemetry is focus on controversy. So if there's issues around a certain bank, we'll take it out of our universe and penalize, put in the penalty box, if you will. We subscribe to several services that are involved in that. Most ESG type organizations or impact organizations have watch lists, and it's becoming more and more sophisticated. But it's really becoming a data game, is what it is, and hoping that one day we get the data we need to make these decisions. It's our job at Genis to take all this data, sift through it, look at structures and models within that data, and get the best perspective given all that information. There's so much information in the world today. You have to be able to sift through it and make intelligence out of it, right? So that's our job at Genis.
Yeah, and I'll just add on your point about lobbying the banks through shareholder activism. I mean, it's working. The Canadian banks actually are getting much better with their sustainability reports. I mean, getting down to the nuts and bolts is always going to be very hard for them and for us, but certainly the transparency is getting better. So I think we should attribute that to a win for ESG investors like us.
Exactly. ESG is such a strong trend right now. It's forcing CEOs to change their ways and become more transparent. That's a fact.
Great. Well, I think we're going to leave it there, Wayne. Thanks a lot for your time. And thanks so much for the viewers for checking out our early edition this week, Thursday, because of Easter. So all the best to you and your families for Easter. And please check in with your portfolio managers and let us know some questions for next week. Thanks again for listening. Bye.